Hi everyone, this is Jadu from Property Framework, and today I want to talk about inflation, interest rates, and their impacts on house prices. I'm going to look at a period between 2002 and 2008 where we had very high interest rates and high inflation, similar to what we are having now. I'm just going to look at what happened to property prices during this time frame and then see if that leaves any clues that we could use to see what's going to happen next for our property markets here, because the conditions look very similar. So let's get into this data. Let's look at the period between 2002 and 2008 when interest rates were increasing. So this is the Australian cash rate from 98 to 2023. As you can see, we are over here in 2023, where we can see a rapid increase of the cash rate up to 4.1. And prior to that, the cash rate only increased in 2009. So in 2009, you can see that there was a minor increase, but the most obvious increase has happened between 2002 to 2008, and where cash rate went from 4% to around 7%, which means that the variable rates would have been anywhere between 6% to around 10%. So very high interest rates in this time frame. Let's look at how the inflation was. Between 2002 and 2008, you can see that inflation is generally trending upwards. It's a bit getting away from that target range of 2 to 3%. So you can see that we have been in a very similar environment even back then, high inflation and high interest rates. So typically, if the cash rate went up to 10%, you would expect prices to drop and the housing market outlook to not look too good. But that did actually happen, because between 2002 and 2008, this was what happened for the capital cities. The top three performers were Adelaide, Perth, and Brisbane. Perth was the best performer out of them all. Perth market grew by about 120% during that time frame. The second best performer was Brisbane, which grew about 108%, and then Adelaide also performed equally well, around 66%. Sydney was the poorest performer, growing only at around 16%, and then Melbourne at around 42%. So what you can see from here is that the smaller capital cities, the more affordable capital cities, have really done well. During the same time frame, 2002 to 2008, the regional markets, especially those are priced under 200K, performed really well. Prices in these markets doubled and even tripled in some cases. Parts of regional Queensland, regional South Australia, even regional NSW, there were several markets which really shot up in value. And the reason why this happened was that these markets were really affordable. It was the affordable markets that really moved very fast. And the logical reason for this is that when interest rates are high, mortgage repayments become high. And therefore, people naturally want to go into areas that are more affordable so that they can manage their interest mortgage repayments. Similarly, with investors want to keep those mortgage repayments as low as possible, and therefore they too shift towards the more affordable areas. And that's what was happening in 2002 to 2008. The most affordable market was Perth and Brisbane, and these markets performed really well. So that was what was happening during that high interest rate, high inflationary environment. So in 2023, we are now in a very similar environment to what we saw between 2002 and 2008. The interest rates are high and inflation has still not come under control, and we are seeing the momentum shifting towards the affordable markets. The best performing capital city market has been Perth, where there has been a lot of growth over the past year. Other capital cities like Adelaide and Brisbane have also done fairly well. If you look at the regional city markets, again, the ones that have outperformed are those ones that are really affordable. Parts of Queensland, for example, central Queensland and northern Queensland, are markets that are really moving forward now. Regional South Australia, regional Western Australia. Also, markets which are very affordable. This is where the demand has been shifting, and there has been a lot of price momentum in these areas over the past year. And growth is expected to continue in these markets in the next 2 to 3 years, as there's really strong demand. The supply in these markets is very low, and in these high interest rate environments, these affordable markets are going to perform really well. So we can have learned something from what we saw between 2002 and 2008. We know for a fact that affordable markets in this high interest rate environment are going to outperform, and therefore we can confidently invest into such markets.